Hello everyone, today is the 8th of July 2026, and all the assumptions that justify the latest crude oil price trend are falling apart. Truce between the US and Iran is over. The Iranian Revolutionary Guard Corps has resumed major enforcement in the Strait of Hormuz. They are targeting tankers and cargo ships that do not comply with their directives. Ships, they claim, must seek approval and use Iran's route instead of the Omani lane. It was kept open thanks to heavy US military escorts. But those escorts are objectively not effective anymore. Officially, 3 ships were hit in the past 24 hours. One is a large Qatari-owned LNG tanker, another is a large Saudi-owned VLCC oil tanker. Unofficially, opposing reports suggest 3 more strikes. 2 were in the Omani waters, one was at the Fujairah port in the UAE, where black smoke was spotted coming off a tanker. Surprisingly, the US military retaliated after Tuesday market close, of course, as usual. They targeted 80 sites on Iranian's southern coast. The Iranian military has already voiced a strong retaliation, and as I record this update, air raid sirens are sounding in Bahrain, warning of an upcoming attack. The biggest news, to be fair, is the United States pulling the 60-day exemption granted to Iran that allowed Iran to sell its previous US sanctioned crude oil. This move is largely symbolic so far. Sanctions never really stopped Iran from selling to willing customers. What this signal is a very high chance the US will establish a tight naval blockade in the Strait of Hormuz. Now you must wonder about the assumptions justifying low oil prices that justify the oil price falling below where they were when the conflict started. We moved from an unprecedented supply crisis to talk of a glut. Popular report on Monday claimed the full reopening of the strait would be faster than investors expect. Multiple analysts and commentators claimed all-time low SPR draws and multi-year low commercial inventories don't matter. All that nonsense is falling apart. The price is simply not reflecting the fundamental reality I have presented to all of you for weeks. Despite many analysts giving up and embracing the narrative that the trend was unjustifiable, it just went beyond common sense. Yes, oil had an upward move in the past 24 hours, but it is still trading at barely $72. As if we didn't lose 1.5 billion barrels of supply in 4 months. As if things still mostly are back to normal. As if the MOU and the ceasefire between US and Iran are holding up strong. What is really happening is traders are defending their massive short position. Rest assured, they will defend them into the next week OPEX. On July 16, WTI NYMEX crude oil options expired. The 17 on Friday, index and stock options expired. In the chart, you can see traders defending the resistance line placed at the opening price of the 2nd of March. They did this despite multiple reports of incidents. They defended it even when everyone knew US escalation would follow. Only after the second official warning by the UK MTO did the market move. But still, the fourth warning wasn't enough for the price to break $70. It was an incredible tug-of-war between short traders and those who were trying to go long under constant threat of being squeezed out. Only after the assured US retaliation news, after US market closed, oil futures prices shoot up. But then the fight between longs and shorts resumed during Asian trading hours. I assure you, the fight till the very end. If short covering begins and the squeeze starts, you might see what I warned weeks ago, an incredible upward move beyond anyone's imagination. Before continuing, I want to highlight this week's premium content on my Slice Finance portal. I published my first on-the-ground deep dive on the Chinese economy, a trade idea for a short on the Korean stock market, plus I hosted my very first live stream on Monday. The recording of the live stream is public, and I included the link in the description of this video, along with a link to subscribe to my premium content on Slice. Now, the second part of today's update. Speculative short sellers are fighting tooth and nail to defend their position, but they piled up extreme shorts at the worst possible moment. The first chart on the left shows this extreme positioning in terms of historical percentile. The scatter plot from HFI Research, right, shows how never before such extreme future shorts were in place alongside very low commercial inventories. The only previous time traders were betting on an oil inventory build that never materialized, and those shorts were quickly covered, is highlighted in the chart. The next chart, you see money managers Brent oil shorts futures at extreme highs. Those positions were barely justifiable before, but now, how do you justify them? They are incredibly dangerous. The short positioning equals over 220,000 futures contracts against only 55,000 longs. The net is roughly 170,000 futures contracts short. That is over 170 million barrels of Brent oil. And this is the positioning as the supply crisis bites the real economy. Shortages are starting to appear, and the military conflict in the Middle East is escalating again. Supply stress is loudly signaled by the 3-2-1 crack spreads that continue to go higher and remain elevated, and it cannot be justified with refinery bottlenecks. The loss of Middle East refining capacity was quickly compensated by the rest of the world a month ago, especially by US refineries that have been running close to 100% capacity since then. And the damages to refineries in Russia have already been compensated by China, India, and even Japan, from where Russia just bought a cargo of diesel. Before we conclude, if you like my content, don't forget to like, subscribe, turn on the notifications if you don't want to miss my future updates. To conclude, I want to show a very important chart on the KOSPI. You can observe how there are three clear support lines. The first broke and became resistance. The second is very close to breaking as I'm recording this video. Only one support line will remain after that. This chart is a textbook case of a stock market bubble, and unless some miracle occurs to turn things around, we are currently in a return to normal stage. Breaking the third support line will mark the beginning of the fear stage and then capitulation. The move will enter the despair phase between the two red support lines. Those are positioned on the two open gaps in the KOSPI index that opened months ago and that sooner or later must close. This is a very strong technical pattern that never fails to materialize. It's only a matter of when, not if. Thanks for listening to my plan today. Thanks for supporting Next, to read my research on JustDario.com, and for subscribing to my premium content on Slice Finance. Feel free to drop your feedback in the comment to these videos. They are always appreciated. Good luck with your trading, and I wish all of you a nice day. Bye.